What if I told you that the global financial system is on the brink of a massive transformation, and gold could be the key that changes everything? In the next few minutes, you'll discover how China is rewriting the rules of money, what it means for the US dollar, and why this could reshape your wealth forever. Make sure you watch till the end, and hit that subscribe button for more insights that Wall Street doesn't want you to know. So over the past few years, China has been doing something unprecedented in modern times. They are reconnecting gold directly to their currency. In simple terms, China is trying to redesign how money works. This might be the most fascinating financial story you'll come across this year. I first noticed it after listening to a podcast by TFTC, and honestly, it blew my mind. Some call this the debasement trade, but it's far bigger than that. Here's what's going on. The People's Bank of China has become the world's largest gold purchaser. China, along with its partners, has been buying gold while selling U.S. Treasury bonds in an effort to weaken the dollar's status as the world's reserve currency. Meanwhile, China has developed the Shanghai Gold Exchange, which is now the largest physical gold market globally. They've added a new vault in Hong Kong and are constructing a network called the Gold Corridor across BRICS nations. This will allow countries holding yuan to exchange it for physical gold. This move gives China's currency a level of trust the dollar lost long ago. Gold cannot be frozen, printed at will, or defaulted on like treasuries. As of July 2025, gold was officially reclassified as a Basel III Tier 1 asset. This means banks can now count it fully on their balance sheets, just like cash or treasury bonds. The next potential step is for gold to achieve HQLA, high-quality liquid asset status, which would let it be used in repo and financing operations, the backbone of the global financial system. China has been systematically addressing the limitations countries face when using their own currencies. Essentially, a parallel financial system is being built, one that can operate outside the dollar and Western financial influence. China's gold-backed strategy could allow them to lend, trade, and fund global development without relying on the IMF. This has major implications for the US, the dollar, and investors alike, impacting interest rates, commodities, and even Bitcoin. So why are countries looking for alternatives to the dollar? Trust. Historically, around 70% of global reserves were held in US dollars, mostly through treasuries. But in 2022, the US froze roughly $300 billion of Russia's reserves. This showed that if your reserves are in dollars, they're not entirely yours. They can be seized or locked at a moment's notice. Countries began asking, if this can happen to a major power like Russia, what could happen to us? This trust issue accelerated central banks in emerging markets to reduce exposure to US assets, selling treasuries and buying gold instead. China's gold purchases can be tracked. For years, their holdings fluctuated slowly, but around the time of trade tensions and tariffs under President Trump, China dramatically increased its gold accumulation. What's important is that this is public. It signals to the world that China could reduce reliance on the dollar. On a larger scale, gold's share of global reserves is expected to surpass US treasuries in the coming months. Officially, China reports about 2,300 tons of gold, but analysts estimate it could be closer to 3,500 to 5,000 tons when including undisclosed holdings. Now let's talk about the Basel III upgrade. Decades ago, gold was a Tier 3 asset under banking rules, meaning banks could only count about half its value on their balance sheets. This system kept gold largely unused. Basel III upgraded gold to Tier 1, allowing banks to count 100% of its value. But there was still a limitation. Gold could not be used for borrowing or repo operations. Repo, the short-term lending system that keeps global finance stable, traditionally relies on US treasuries. China is now aiming to elevate gold to HQLA status. HQLA assets are highly safe, stable, and liquid, and can be used as collateral for loans and infrastructure projects. Right now, US treasuries hold that role, which is why the dollar dominates global lending. If gold achieves HQLA, countries could finance major projects with yuan backed by gold, entirely bypassing the dollar. This was a key discussion at the BRICS summit. China had long tried to convince BRICS nations, Brazil, Russia, India, South Africa, to use yuan for trade. These countries hesitated, asking what the yuan was backed by. China offered gold as collateral, but trust remained an issue. The solution: the Gold Corridor, a network of vaults across different countries, each connected to the Shanghai Gold Exchange. Every gold bar is tracked by purity, serial number, and ownership. This ensures decentralization, verifiability, and accessibility. The second problem China addressed was volatility. Gold prices fluctuate daily, which is risky for financing. China is using a moving average system to stabilize settlement prices over long periods, reducing risk and making gold a more predictable asset. With this system, resource-rich nations, particularly in Africa, could deposit gold with the Shanghai Gold Exchange and borrow yuan for infrastructure projects. China finances development, gains influence, and bypasses Western institutions like the IMF. Gold moves from a passive store of value to a tool for real economic growth. The U.S. has been aware of these developments. Earlier this year, the U.S. repatriated gold from London back to American vaults. Official explanations mention tariffs and audits, but the underlying motive is likely strategic. Control of physical gold is critical if gold becomes a globally used collateral asset. Currently, the U.S. holds roughly 8,000 tons of gold, the largest stockpile in the world, but a significant portion had been stored overseas. So what does this mean for gold prices? Financial institutions traditionally hold about 20% of reserves in gold. New guidelines suggest raising this to 30%, creating roughly $2 trillion in new gold demand globally. Unlike dollars, gold cannot be printed, so this demand could drive prices to historic highs. Some predict gold could double in value over the next 5 years. How does this affect investors and assets like Bitcoin? The logic may explain why both gold and Bitcoin prices have been suppressed. Countries want control before letting prices surge. Looking forward, we might see a split. China and BRICS building a physical gold-backed system, and the US and the West developing a digital, decentralized system, potentially centered around stablecoins or Bitcoin. Gold represents trust built over millennia, tangible, slow-moving, and historically stable. Bitcoin represents trust through energy and math, digital, transparent, fast, and borderless. China's approach is about control and hard collateral, while the US may leverage openness and digital innovation. For the first time in modern history, governments may compete to define what money truly is. Historically, there has been one dominant global standard, but we may now enter a multi-monetary era. Gold-backed money led by China and BRICS digital, programmable money led by the US and Western nations. If both systems coexist, asset prices for gold, Bitcoin, and other financial instruments could reprice dramatically over the next 5 to 10 years. This is not just theory, it's happening right now, and understanding it early could change your financial future. If you want more insights into the world's most powerful financial moves, hit that subscribe button, turn on notifications, and make sure you don't miss our next deep dive. Remember, knowledge is the real wealth.